And I feel like just as it took about 2 years for those profligate policies of 2020 to kick in, and the height of inflation was somewhere in the early 2022. Right now, we're setting ourselves up for extremely deflationary environment in 2024.
On today's episode of the WTFinance podcast, I have the pleasure of welcoming back Alex Gurevich, who's the CIO and founder of Honte Investments. So, Alex, thanks for coming back on the podcast today.
Thank you for having me again. It's good to be here.
No problem. Yeah, and last time we talked about your book, but yeah, a lot's happened since then, which is crazy to think. So, from your perspective, what are you currently seeing, I guess, in macroeconomics and the markets in general that really that's really driving the markets? What's your thoughts on that?
Well, if you think of markets as waves which like kind of flood in and then recede, I feel like even a year ago we're at the end of the wave going one way, and I feel like right now the wave is receding. And when the water is high, it's very easy to imagine that like that's where it's going to be, but really a lot of processes which were put into place in 2020 and 2021, I see reversing in 2022 and 2023. So that's, to me, that's what dominates my field. In 2020 and 2021, there was so much new money created through fiscal transfers, easy monetary policy, kind of post-COVID asset boom, and all of those things are beginning to reverse, and we're seeing some weak spots beginning. In some weak spots, some balloons are beginning to pop, like the recent mini banking crisis that we had. And I feel like just as it took about 2 years for those profligate, not really in a bad way profligate, but necessarily profligate policies of 2020 to kick in, and the height of inflation was somewhere in the early 2022. Right now, we're setting ourselves up for extremely deflationary environment in 2024.
Yeah, it's interesting. So, as you said, the last 2 years we've had higher inflation than expected, and now we're sort of going the opposite way. From your perspective, this inflation that we experienced, was that due to just supply chain issues, and now is that why we're seeing it sort of decrease, or is it the Fed actually acting? Are they actually having an impact on that?
Well, the supply chain, as somebody I was debating with pointed out, that's like the easy part of inflation. So like if you think that core inflation went to like, or kind of the underlying inflation went up to 5%, which is high by most people's standards, it really printed more like 9% in 2021, 2022. This extra was supply chain issues, which got resolved, and that went away. So some people think that the other 5% are going to be hard. I think it'll be extremely easy, because what's happening is when inflation goes down from 9% to 5% for any reason, you have already that already in itself means tightening, because the real rates go up, not only on the side of Fed raising rates, but also on the side of inflation moderated. And the current moderation of inflation has nothing to do with the Fed policy, because Fed policy works with such a huge lag. We have not seen any impact, or barely any impact, of all the interest rate hikes that happened. We're going to start seeing them probably later this year. That would be like the natural expectation of how long it takes to start seeing it. So we have not seen anything yet in terms of pressure on asset markets, or just kind of deflationary pressures that are building. However, all the leading indicators are showing this way, like what is happening with various freight indexes, shipping costs, commodities, all this stuff like moderating, and what's going on in the rental market, which still officially shows inflation because of the lag, while we know that it's already deflation, rents are falling countrywide. And what is happening in commercial real estate. I mean, I don't have the numbers, but anecdotally, what I'm seeing in commercial real estate should be absolute devastation, should be like annihilation that has never been seen in the history of humanity, of any kind, like broadly. I mean, it probably would be seen locally, but the way commercial real estate might get annihilated is pretty amazing.
Yeah, well, and why is that? I guess we can focus on that for now. Why do you think?
Well, just the demand for office, like it's more specifically about office, but there are other areas. But just the occupancy demand is falling. I mean, people need probably like 70% less office space going forward than they needed, because people are not fully coming back to work. A lot of people generally going to entertain like the average, kind of the par for the courses hybrid models. And maybe, honestly, I'm a little bit speculating here because maybe that's not what's going to happen. There are sometimes I can say I can back it up by numbers. Now I'm just kind of saying like, hey, look at downtown San Francisco. Nobody's coming. Hedge funds are not coming back there, or if they come back, they're going to need so much less space because it used to be the office space that used to be for an 8-person company, now it's going to be an office space for 30-person company because they're gonna people gonna rotate the times which run in the office. And being in the office in certain hours for so many businesses is just kind of ridiculous because people work at different hours. For example, why would I tell someone who works for me trading in Asia overnight to come to work from 8 to 5 in some San Francisco office? So it is like it's not that people don't need office spaces, but they just demand is gonna, I think, and I think it's a slow process because leases are expiring. Many people had multi-year leases and they're not renewing the same leases, and I think that's gonna be a tsunami.
Yeah, it's crazy to think. If you go back to what you said before, you were talking about how you don't think sort of tightening interest rates have had an impact on I guess the markets and on the economy as much as it will in the future. I'm sure lots of people would push back and say, hang on, we've had, SVB Bank blow up and we've had a few other banks blow up as well. So do you think that could be a lot worse in, I guess, Q3, Q4, and maybe early next year? Or do you think that, what's your thoughts on that?
Well, financial assets, it's not actually the economy, right? Financial assets are the leading indicator. For example, in 2022, we had a significant correction on asset prices. They, not just because if you look, it's very seldom you have a situation that both stocks and bonds go down. So in the past, there has not been, so that the value of global asset prices has declined a lot, which offers less collateral and less possibility for money creation on the system. So the money supply has been shrinking a lot, but that's actually almost like proves my point about the lag. Obviously, tighter policies, they directly affect money supply, and that has declined. However, if you look at employment, it's very strong. And why shouldn't it be strong? Because people were given so much money in 2020 that takes a while to suck this money out of the system. So consumer is strong. People still want to buy their coffees at Starbucks. They still do all those, like, look, if anything, post-COVID, a lot of people just really enjoying life and they like want to go out to dinners. So services are pretty big. Like there is a lot of demand for services, but that is gradually, it will take a time for this excess cash to get sucked out, and sucked out it's being really, but it's a process, and it's going to take a while for the companies to slow down their hiring. I'm reluctant to call like when certain things like job opening numbers softened up, or like you have a slight tick up in initial jobless claims. I'm reluctant to say that's it, job market is falling apart. Well, it will fall apart at some point, but there's been a lot of false signals there. A lot of time people like over the last years, like, okay, everything is falling apart, but then it's a slow process because the system was not over leveraged. There were not that many weak spots. But if there were any weak spots like Silicon Valley Bank, they did blow up. So that shows that the pressure is there. It's just that there's not that so many weak spots yet. Does that
So
make
then,
sense?
yeah. So then, for the pressures to continue to remain or even increase, do you think the Fed are going to, I guess, remain tighter for longer? Because there's this thought that they're going to pivot and they're going to sort of slow down increases in interest rates and even potentially reduce them. But do you see them maybe hold them high for longer, and then we will see that break?
Well, I think like thinking in terms of how long Fed will stay, Fed policy in abstract makes almost no sense. Because if you remember in 2021, or like early 2021 and 2022, they were waxing poetic about how they're going to keep rates zero, like through 2024, like through some really long periods of time. They were really, really very specific and very articulate about the fact how they're going to keep the rates low. And then they hike like maniacs in 2022. So when they say we're going to keep rates higher for longer, that is not actually anything to do with the policy. That's their view on the economy. They think that their economic the inflation will not come down and push them so fast to force them to low rates. Now, when economy slows down and inflation will come down, they will have to cut rates. Now, Powell said himself a couple of really interesting things. One of the things he said is that he said multiple times, he said about long and variable lags, agreeing with my point, and he said that the full effects of tightening has not yet been felt. So he agrees with that. He just doesn't know what they are. So, and the second thing he said that recessions are non-linear events, and we have no models for recessions. So the way when things are gonna start speeding down, it's not gonna, it's gonna be self-accelerating. It's like you're rolling, like right now, I believe we're already rolling down a hill, that is inflation is slowing down, and we're pushing the accelerator. And that, just as in 2021, rising inflation was self-reinforcing process, and inflation went higher than most people, including myself. I was wrong too. Inflation ended up being more pernicious than people expected. But same thing will happen, I think, on the other side of this equation. And they will be, and it is not a matter of their choice. They will probably stay tight longer than they should. I think they should already be easing, but they're hiking still. But it doesn't mean that the fact that they will stay tight longer than they should does not mean that they will stay tight for long. Because they might, data might turn around so rapidly that they might be forced to, like market pricing easing this summer is not that unreasonable. Because even if you think that it's not a sure thing that they're going to start easing this year, if they do, that'll be probably much more than the market is pricing. So like if they do start easing, it will not be like 50 basis, like little eases. That's going to go to zero in a very rapid manner.
Yeah, I think a trend that we have seen is that they're responding a lot more rapidly to these events, as we saw with Silicon Valley Bank and other events during COVID. They're just going to do whatever they can as quickly as possible.
Well, I think like events also develop very fast. I mean, no matter how rapidly they will have to respond to events, because they will, like, if that deflationary train will start going, no matter what they do, they will have trouble catching up with it.
Yeah, and do you think the markets will react? Because if we look at especially equity markets, they've been very bullish for the past year, at the start of the year, especially eight companies I think have been the majority of the gains in the S&P. So do you see that continuing, or if this were the case, then do you think that will they react, or is this where people are going to put their money, or they're going to start maybe putting their money in bonds? Because if rates were to drop drastically, if we're going to have deflation, then some of these bonds would increase in value. What are your thoughts on that?
Well, of course, bonds attract money when Fed is cutting interest rates, but typically it's eventually good for stock market as well, because it's not a zero-sum game. Just as right now it was not a zero-sum game as everything went down because the money was being taken out of the system. When the Fed starts increasing money supply, everything will go up again eventually. But the path might be not certain, because as we discussed, like we're still having another hike ahead of us, most likely. May 3rd, sorry, the market projects most likely chances of hike, and barring some big things happening, that's probably what's going to happen, right? Because there's not that much data to sway the Fed, so most likely they'll just follow that path. So we still have liquidity being sucked out of the markets. To what extent it will put pressure on equity and create headwinds to equity markets, well, who knows? I would not like read too much into equities markets going up or down 5%, because just the notice when they went down in 2022, it didn't like cause immediate crash of real economy. Just as bounce of 10% bounce on stock markets is gonna create kind of immense easing of liquidity conditions. Conditions are still tight and tightening. Fed is still hiking. Inflation is still coming down. So every direction, money supply tightens. But when it comes to, there are 8 big companies, there are secular processes going in place. There are like big civilizational shifts are happening. We do not really have an analog of Google or Amazon or Facebook, or to look back into 17th century, right? We don't have like a good thing to compare it to the effect of generative AI, right? What is it going to have over the next couple of years? Because it seems like we're getting like AI news every hour, right? Every hour, like now some kind of new huge breakthrough now happening. There is no parallel to that historically. So I would be cautious, a little cautious about saying it's like, oh, let's short stock market because it has to go down, or let's be long stock market because it has to go up. It's a little bit of there's too much uncertainty there. There are times when it's easy, and I don't think it's an easy time.
Yeah, it's interesting. So if we go back to the data, you mentioned that there's been sort of quite a lot of false starts to when we see, I guess, unemployment increasing and potential further impact on the overall economy. So what are the key, I guess, data points that you're watching to say, okay, maybe we've gone past a false start. It looks like this is actually, you know, the end game for this cycle at least.
That's a really good question. And it's kind of one of those things when you see it, you know it. But I think you just have to be really careful and watch the aggregation of data. Because over the last 12 months, data has been consistently mixed. There will be some weaker numbers and people like, oh, manufacturing index, whatever, manufacturing reports are so bad, we're in recession. And like, wait a second, job reports are so strong, we're still economy is still heating up. Then like some other, I think you have to watch. It's interesting to watch job numbers in aggregate, and I think to see, but be very careful not to be swayed by monthly fluctuations. It has to be like a good aggregation. We have a whole bunch of different job indications. We have household survey, we have establishment survey, we have weekly um, continued claims, we have new initial jobless claims, we have JOLTS, the job opening numbers, we have all those reports. So when we aggregate them, and if there is a really consistent story of this going down, to me that will tell me that the rise in real wages that and the contraction of margins makes it less interesting for companies to hire people, and that will probably start, and that process will probably be self-accelerating. I mean, of course, just watching inflation, I think in terms of Fed reaction, it would be interesting to watch the rental inflation because we know that's going to come down. That's already mathematically baked in. This is not like a speculation. We know that number, which was a huge positive contributor to CPI last few months, despite the fact that economically it's negative, that's going to turn negative. So because that's just mathematically impossible not, it doesn't actually matter what's going to happen. We could have a huge inflationary boom for the next 12 months, but the own equivalent rent will turn negative because of its lag. So but when they do, that will impact perceptions a lot. So like you can watch this in terms of policy implications because the Fed, for some reason, even though Powell himself noted that thing with their ends, for some reason that seems to be such a logical problem. Like, why would he say that? No, he's neither him nor any other Federal Reserve Board is any stupider than me. They know all those economic things much better than me. That's what they do all day, and they have the best information available. It's just somehow they're constrained in their thinking. If they know that this is the case, why are they still reacting to inflation numbers produced by this 18-month lagging indicator? But I think like their policy might change once they actually see those numbers change.
Yeah, it's interesting. So if we, you say we're going to experience this massive deflation, what would that mean for companies? I guess earnings would drastically decrease. What other impacts would that have, in your opinion?
Well, we're seeing a margin, probably margins will keep decreasing in this environment until the policy reduces just because of diminishing money supply. I would be careful though. I think people sometimes make an error of conflating corporate earnings with performance of stock market. Like decline in earnings recession does not actually mean stock market. Stock market goes up when there are more buyers than sellers, and it goes down when there's more sellers than buyers. It's not about earnings. I mean, earnings might change the mind of some sellers and buyers, right? But those are the very small amount of people who might change their mind because those are speculative people. Most people who buy or sell stocks are not doing so speculatively. Like if you have 401k, which has defined contribution and just buy a certain amount of stocks every month, you're not even looking at earnings. It's just done automatically. So the capital, the fundamental flows in the economy is such more important than various things that might influence people's psychology because those psychological impacts are very short term. Those who like panic and sell, they later buy. Those who stretch and buy later have to sell. That evens out, but the fundamental flows remain. So the fact that money is getting sucked out of the system is important. The fact that earnings might be in decline, honestly, is less important. Meaningful, but less important.
Yeah, it's interesting. So from what I'm hearing, you're saying, obviously being careful in these overall trends that the just because this happens, the stock market goes down. So when this happened, what are you? Do you have to be more selective in, I guess, companies that you're looking at, or are there any other assets that you're specifically looking at that you think will perform differently during such a period?
Well, my general approach, I like to look at assets that will perform well over a really long period of time. That I'm like, can say like, I don't know what's going to happen to this asset in the next 6 months, but in 3 years, I have pretty good results. So like right now, we like bonds because government bonds because uh, I don't know when the policy will change, but it will change. And I whole experience of every rate cycle shows that whenever the curve is inverted and the rate cuts are priced in, not only they will happen, but much more than actually priced in will happen. So not only they will cut, but they will cut much more and stay probably low rates for longer. So I think that there is huge upside on betting on lower interest rates. When it comes to assets like stock markets, I think you just have to use whatever system you're using. I'm not going to give advice on individual stocks here because that's not even my specialty, and I'm not even supposed to. But you choose what you believe in, whatever methodology you use, and I think you could choose and pick and choose it. If you think this is a good investment over long run and the price is reasonable, you can put money in it, but be prepared for all sorts of fluctuations. I think there is a different thing. There are times when there is a good times to buy stock market, and I've done it in the past, and I've done really well on it. Stock market or any kind of risky assets, when everything is bombed out and everything looks horrible and interest rates are being cut aggressively. Like that methodology allowed me to really buy stocks in the end of 2008, beginning of 2009, which was a huge reason for my long-term success. That I honestly, big reason for why I'm a successful person is because I was 100% invested in stock market in March 2009 when it hit the bottom, right? And same thing in March 2020. It does not matter how bad things are. When policy starts kicking in, that's time to buy. It does not matter like how pernicious what's happening, like whether it's pandemic, global financial crisis, devastation of financial system, war. It does not matter. When the policy kicks in and starts printing dollars, you should buy assets. That's kind of the simplest advice I can give, but we're not at that stage yet. In fact, the policy is doing the opposite. So I'm still feeling somewhat cautious.
Yeah, no, that's fascinating. So in terms of, I guess, the bonds that you're looking at more long dated bonds that you think will potentially benefit from this, change in monetary policy, or what are your thoughts on that?
Well, I think I'm reluctant again to give like specific advice on specific maturities because that very much depends on your view, right? If you think, see, the faster you think the rate cuts will come, the shorter term you want to bet. The more like you think they're going to stay rates tight for longer, then the more further out the curve you want to make. Also, it depends if you're an investor. Are you a leveraged investor? Because if you're a leveraged investor, you can get the most bang for your money with buying longer duration bonds because they're more volatile. If you're a leveraged investor, it doesn't matter. You just take a certain amount of risk and you leverage to that risk. You could do as much risk in 2-year notes as in 30-year notes. So there are, I think like that is just depends on your portfolio, your needs, and more tuned up of your views where to go on the curve. But what I would not do myself is to make heavy bets on what's going to happen in the next 3 months. Because I think that there is just, if you remember how much chop happened during March 2023, it's like front-end interest rate futures were making huge swings, which they were jumping more than in any time in my memory. They were jumping around more than during even COVID crisis, more than during September 11, more than during global financial crisis. I think there was some record moves there, like not seen maybe since 1987 stock market crash, like just the way things were jumping every day. And there were some good tactical opportunities opened up by that, but to say what is actually going to happen would have been pretty hard. But if you go a little further out, you may see opportunities.
Yeah, that's a great point. As you said, it's very frothy and it's a very dangerous time to be doing it for the short term. So, are there any other key drivers? So, from what I'm hearing, you're mentioning policy is obviously a key driver. What's happening, interest rates and sort of yeah, inflation as well. Are there any other drivers that you're currently watching, or is it really mainly focusing on that?
I'm mostly focusing on that, but of course you cannot like ignore the global situation. It is interesting to see what China is doing always. It is obviously there is a war going on in Europe, that there are always like factors that you have to keep watching and they may have effect. You have to take it, politics and geopolitics is hard because it's very easy to get caught up in geopolitics. But usually, as I say, usually like for example, like if you're studying what's happening in some countries, sometimes it's tempting to really closely watch the elections in this country and the policies. But in the end, things kind of still are driven by very fundamental factors: interest rates, current account, inflation, and it does not so much somehow the political impacts even out. For example, oil is exactly where it was before the war. It went all the way to 130 or something, right? WTI oil. It fell like to 65, I think, only very recently in the middle of crisis, right? And now it's like 80 something, just where it was before the war, even a little lower. So how do you bet on this, right? Like if you were getting overexcited and saying oil was going to 200 a year ago, you would be killed. But also if you try to short oil if you didn't catch the exact right moment, you would also get killed. So geopolitics is tough and it's unpredictable. But I think it is important to understand what's going on with commodity demand, for example, coming from China and things like that.
Yeah, it's a good point. And if we stay international and maybe stick to policy, the Bank of Japan is they're having some interesting changes at the moment. I know that's the sort of a trade that you've made in the past, USD JPY. So I'm not sure if you have any thoughts on what's currently happening there, and if you think they could potentially shift their policy, or is it really too early to tell what's happening?
It's hard for me to tell. I've been very successful with yen trade, yen weakening trade in the years 2012 to 2015. Unfortunately, I didn't catch that yen weakening trend last couple of years. I did a tiny bit of it, but really not any meaningful amount. And I think that was one of the big mistakes of last 2 years that I made, is not to get on the yen weakening trend. I guess because in my mind, I was more thinking of an environment like 2004, 2007, when the Fed was hiking rates, but dollar stayed weak. And yen was actually very strong in 2004, and I was expecting something like this to happen this time. So I was not expecting that weak yen. But I think if I were really more rigorous about executing my strategy, I probably would have done better with this. And this is like one of the mistake in one of the notch in my big mistake column, not to take big advantage of yen weakening. So nowadays, now it's hard to tell. I'm kind of have this theory that BOJ, Bank of Japan, might have the last laugh of all the central banks, because they were kind of ridiculed for not being so staying easy and just holding the line. And maybe they are not having inflation catastrophe in Japan, but maybe all other countries will have now deflation catastrophe. And Bank of Japan is like, see, we just can't hold steady. Maybe just keep to the policy, and other people will be like, did all this frantic tightening, then all the frantic easing back to zero, and Bank of Japan will be like, we just still here. So I have this like kind of inkling feeling that they might turn out to be smarter than the other central banks in the end.
Yeah, that'd be really interesting. I guess maybe they haven't been as affected because they're a lot closer to China and other manufacturers like that, and that's really where most of the inflation has been. So interesting to see.
Yeah, well, we'll see. I mean, it's quite possible that Japan might have the problems, but I mean, inflation is higher there, but like I don't see, I'm not hearing news of Japan dissolving into two-digit inflation because of the weaker currency and easy policy, right? They're kind of stuck in that cycle. And paradoxically, now that global inflation reversed, it might work out for them.
Yeah, and I guess as everyone else is cutting, if they don't have to, then that could be beneficial for
Yes,
the
yes,
currency.
that's a little better, right? They don't have to create any of this commotion in their markets. That there's a lot of like pain and commotion in U.S. markets between these first unprecedented hikes, and if I'm correct, followed by pretty rapid, not unprecedented, but rapid cutting rates if it's going to start, which I think most likely to start second half of 2023, but could very easily start later or even sooner. It's possible, but like I shouldn't be surprised if it starts later, but it will start. And there's a lot of volatility from that. And Bank of Japan may be like, whatever, we're just chilling.
Yeah, we've done the right thing. So, Alex, thanks so much for your time. I appreciate it. We've covered so many topics. So, my last question is, what is one message you want people to take away from our conversation?
Well, one of the messages probably would be that even people who, myself, who talk often with a lot of authority and can make a impression that I know a lot, that really the uncertainty is very high in the world, and it's so easy to be wrong about almost anything. And we have so many experts so profoundly disagreeing and expressing absolutely opposite views on those things. So just be very cautious, thinking more in terms of following frameworks, like descriptions of the world, rather than conclusions, because conclusions could be very different. And I think in this market, it's very important to stick to what you, well, at least my approach is to stick to what you know should be true over the long run, rather than try to resolve all the like commotion of and all the conflicting cross currents that are going now. I think it would be very difficult to do so.
Yeah, definitely makes sense. And sorry, I just have another question. So, I was just one thing that we've sort of been, a lot of people have been talking about. Maybe we're going to a new normal after 2020 with higher inflation, less deflation as we experienced before. But I'm assuming that you think we're going to go back to sort of where we were pre 2020 with boom bust sort of scenarios. Is that your thought, or what are you thinking is going to happen in the future?
Well, I don't see any signs of us going to new normal of higher inflation, higher rates. I don't think, in fact, everything that I see confirms my theory that we're going back to zero. But I know that theory, that's where people completely disagree with me, and people who disagree have strong and valid points. I just have different perspective. I'm not gonna say that have to be right about this. This is just my opinion. And there are a lot of reasons. I feel like the cyclical reasons will bring us down to zero, but then there are some longer term trends which could be both inflationary and deflationary. Like on one side, you have all this like offshoring and deglobalization, but on another hand, we have still like AI and automatization, and globalization is a bigger trend which is still continuing, even if it's going to be pushed back against. So how these trends will interact, there is a lot of different opinions you can have. I think this is not the time of 1970s. I think this is a very different time, and I think zero rates are the new normal.
Yeah, interesting. And when you were mentioning there, different opinions, and never that sort of made me think of a lot of people I've interviewed who've said that they think it's new normal, and obviously you're on that different have that different opinion. So it's really interesting to hear everyone's opinion, why they think that, and then yeah, as you said, we'll find out what happens in the future.
Okay.
Yeah. So Alex, thanks again. So if anyone wanted to find out more about your work, I know you have Twitter. You've also released some amazing books. So those are the best places that people can find what you do.
Yes, so the best place to trace me through Twitter, it's like my initial and my last name, Gurevich23. And you will find link to my corporate website and to any books I published. My corporate website for accredited investor qualified purchases is hontainv.com. The way the firm is spelled plus INV like investment, hontainv.com. You could find the firm's website, but through Twitter you probably can trace most of the things I do.
Perfect. I'll put that in all the description below, but thanks again for your time.
Thank you. Thank you. It was a pleasure.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.